stop buying treasuries and move to higher yielding agency, muni, and corporate bonds? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So one of the questions we often get asked is, should I stick with treasuries or move to higher yielding bonds like agencies, munis, and corporates? And this question is particularly top of mind at the moment as bond investors ponder a possible rate cut in the not too distant future at the upcoming FOMC meeting. So with that in mind, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. How might you choose between treasury, agency, municipal, and corporate bonds? As many of our Diamond NestEgg regulars know, U.S. Treasuries are considered to be the safest and most liquid fixed income investments in the world, primarily because, for all practical purposes, they are viewed to have no credit risk, no default risk, and trade every day in large volumes. When I use the term treasuries broadly, as I just did, I am referring to treasury bills, notes, bonds, zeros, tips, and I-bonds. Basically, all the debt issued directly by the U.S. federal government in Washington, D.C. When we buy treasuries, our expectation is that our government will pay us the interest owed to us when due and repay us the principal at full face value upon maturity. Now, as to the credit risk, just a few years ago, I could have mentioned here that treasuries hold the best possible ratings from all three big ratings agencies, and this would have made my point. However, this has changed in the meantime, as all three large ratings agencies, S&P, Moody's, and Fitch, have downgraded the U.S. The agencies had two reasons for doing so. First, the fact that our national debt has continued to grow, which might potentially threaten the ability of the U.S. to repay all bonds when they mature in the future. And second, the experience that every few years we seem to have a debt ceiling crisis and a default scare, which might cast a bit of doubt on the willingness of the U.S. to honor all its obligations. So there are clearly some risk factors here that apply to the U.S. and the treasuries it issues, and nobody can predict the future and exclude all risks with a full 100% certainty. That said, at the time of this taping, our country has never defaulted on its debt, even when we've had government shutdowns in the past. And as I always say, if it were to ever default, we would have much bigger problems. So, as the longtime members of our community know, when it comes to treasuries and a possible U.S. default, my standard assumption remains a no default scenario. With that in mind, whether treasury, agency, municipal, or corporate bonds, or some combination thereof, might be right for you, this will depend on a number of factors, but primarily it will depend on your risk-return profile. Let's start with the most conservative investors first, those with the lowest risk, lowest return profile. These investors would most likely allocate most or all of their bond portfolio to treasuries because, as I mentioned earlier, treasuries are, for all practical purposes, considered to be the safest, most liquid fixed income investments in the world. We expect the government to pay us what's due on time, and we work with the assumption that because of the liquidity in the treasury markets, we can generally find a buyer in the market for our bonds in case we need the cash. Treasuries are also not callable, meaning the U.S. government will not redeem them early. So when investors buy treasuries, they don't have to deal with unexpectedly losing out on future interest payments and early return of principal, which is what happens when a bond is called early by the issuer. So the safety, liquidity, and non-callability are the three key reasons why the most conservative investors tend to allocate most or all of their bond portfolio to treasuries. And generally speaking, folks who are closer to retirement or already in retirement and prioritizing capital preservation rather than capital growth are more likely to fall into this most conservative category. For those who are slightly less conservative, who don't mind taking on a bit more risk for a bit more return, agency bonds might be attractive. Remember, whereas treasuries are always explicitly backed by the U.S. government, agency bonds may be either explicitly or implicitly backed by the U.S. government, meaning that in both cases, agency bonds are still very safe. However, they are usually less liquid than Treasuries, and they may be callable. A majority of the new issue agency bonds that we've seen recently have been callable. So, when investors buy agency bonds, they will often have to deal with reinvestment risk if or when an agency bond is called. For those who are even less conservative and generally in a relatively high tax bracket, municipal bonds are up next. The main advantage of most, but not all, there are exceptions. So the main advantage of most municipal bonds is that they are exempt from federal income tax. And they may be exempt from state and local income taxes as well for investors residing in the state they were issued in. Municipal bonds are generally considered safe, but defaults have happened. So credit quality and name selection are very important here. Liquidity varies depending on the issuer and the size of the bond offering. The larger the size of a municipal bond offering, the more liquid the secondary market typically is for that municipal bond. Most municipal bonds are also callable. So, investors for whom municipal bonds may not be a good fit, perhaps because they're buying in a tax-advantaged retirement account, or because they're in a tax bracket where municipal bonds do not make sense, investment-grade corporate bonds are up next. Investment-grade corporate bonds are also mostly considered safe, but slightly less safe than municipal bonds. According to Moody's, default rates tend to be somewhat higher for investment-grade corporate bonds versus investment-grade municipal bonds. So again, credit quality and name selection are very important for investment-grade corporate bonds, just as they are for munis. Also like for munis, liquidity varies for investment-grade corporate bonds, depending on the issuer and the size of the bond offering. The larger the size of a corporate bond offering, the more liquid the secondary market typically is for that corporate bond. Most corporate bonds are also callable at the time of this taping. And finally, for the least conservative investors, those willing to take on the highest risk for the highest return, there's high yield or junk corporate bonds. High yield bonds promise high returns, as the name suggests, but they are the least safe relative to the other type of bonds we just discussed. High yield bonds are also typically less liquid than investment grade corporate bonds, and many are callable. Personally, I'm not a huge fan of private retail investors putting their money into individual high yield bonds because I think it runs counter to the fundamental safety, predictability, and stability that bonds generally have to offer in a portfolio. But as I always say, everyone's financial journey is different. So, what about you? What's your risk return profile? How much do you care about safety, about liquidity, and about callability when it comes to your bond investments? Answering these three questions should help guide you in the right direction of whether you're very conservative or whether you're somewhere here or even here. And once you've figured that out, then you can decide which type of bond or combination of bonds might be right for you. Here's a personal tip I have for you. If you're relatively new to the world of bonds, or if you find that you're having trouble answering some or all of these questions, start with Treasuries because they are the safest, most liquid, and not callable. And also because at the time of this taping, you can buy Treasuries at auction for as little as $100 on Treasury Direct, or as little as $1,000 at many of the leading brokerage firms. This allows you to test the waters, so to say. Also, generally speaking, if you're older and are about to retire or already in retirement, you would most likely be somewhere up here, with Treasuries still being the preferred choice relative to everything else here, because again, they're the safest, most liquid, and not callable. Of course, even if that is the stage of life that you're in, you may still want to add some agency bonds and or even municipal bonds and corporate bonds to your portfolio, depending on your risk return profile and tax bracket, and or if you have a bit more excess cash to play with in your portfolio, for lack of a better term. If, on the other hand, you're concerned that holding just Treasuries in your portfolio will not yield enough to meet your income needs or retirement goals, then you may have no choice but to move down this risk-return spectrum and add either some or more non-Treasury bonds to your portfolio. Basically, you may have to take on higher risk in the hopes of higher return. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And don't forget, if you want to take advantage of the current attractive bond rates before they potentially come down, then check out this video. Here are our bond courses. There's still a day or so left to save. Prices won't be this low again. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern Time on Monday, September 1st. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or Bond Masters individually. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.